and go.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
I don't know how we're going to have AI if this is a state of the art. I mean, I don't see where it's coming from. You think they have something that sounds more natural. Anyway, I hope everybody's doing well, and we're having yet another update in the market. And I was talking today about, you know, you got to kind of consider that America goes $1 trillion into debt. That's just the that's not the Fed though. That's the government is going $1 trillion into debt. The Fed is going $500 $1 trillion into debt. You know, buying up more paper again because of the problems they're having with the overnights and the repos. Other central banks, China is putting in $500 billion in stimulus here and there to fight the virus. Not to fight the virus, to fight the economic impact of the virus. But it doesn't matter. Everybody's got an excuse all the time to spend the people's money, you know, because these debts accrue to the population. You know, when they talk about the national debt of the United States and the Fed gets added to the national debt. In other words, the Fed has its own balance sheet, and every year they declare a profit or loss. If they're willing to carry and roll over $5 trillion in debt on their balance sheet, that doesn't show up as a profit or loss to the Treasury of the United States. But should they take losses ultimately on the balance sheet, those losses accrue to the bottom line deficit of the United States. If they have a profit, which they have had for several years, of course, as they were rolling over notes, they actually booked a profit for most of the years in the last 10 years. That money detracted from our deficit. Now, if the Fed starts going the other way and starts adding to our deficit, that can explode really fast. But the gist of it is, look, the Fed borrows money on behalf of the people. The government borrows money on behalf of the people. The corporations borrow money at rates that are subsidized by the Fed at ultra low prices. And they're not doing it on behalf of the people. They're benefiting for themselves. And very wealthy people obviously can borrow money at low rates, benefiting themselves. So what they're doing, because when you have a national debt, they don't talk about dividing the national debt among rich and poor people in a proportion to their wealth, right? They call the national debt equally distributed. So each person is responsible. You know, I mean, of course, if push comes to shove and you actually have to repay the national debt, I think it's, well, I don't have to think, let's take a look. This might go too fast for it to be resolved on the system, but we'll find out in a minute. Go to the national debt clock. There we go. And probably this will be too fast or something. I'm not sure how it'll resolve on your screen if you can see it. But anyway, the gist of it is you got 23 trillion, 23.2 trillion in national debt. Our current deficit is over $1 trillion. That's for the fiscal year of I guess it's 2019 fiscal year that ends in June. This kills me. Income tax 1.7 trillion, payroll tax 1.2 trillion. So that's $3 trillion paid by workers, right? And corporate taxes $234 million. So people pay $3 trillion in taxes, corporations pay 200 billion in taxes. That's really sick. But anyway, the bottom line is, and when you talk about your national debt, it's per citizen $70,000. They don't say per corporation national debt. Corporations are completely exempt from caring about the national debt. It's not even a thought that they should be responsible for it in some way, shape, or form, even though it's really the lack of corporate taxation that runs up the debt. So per taxpayer, $188,000. Per citizen, including your baby or whatever, $70,000. The reality is, though, that when they talk about this number and they say, okay, great, but in reality, nobody in the bottom 50% has $70, let alone $70,000 to pay the national debt off. So if you're in the top 50%, it's more like $140,000 per person. And so your family is indebted more like $500,000, even if you're just in the top 40%. And it gets way worse than that when you really think about it, because who can really afford to pay it? Now, the trick to the national debt, though, is the top 1% never have to pay it, or they'll pay a limited breakdown. They'll distribute it evenly among whoever. So if you say, okay, everybody in the top 30% has to pay $500,000, that'll kill you and kill normal people, but very rich people will be like, yeah, sure, 500,000, we'll pay that. All right, we'll compromise. And it's nothing to them. It's not a proportional distribution. So what's going on is that the government, and of course they're benefiting from all the stuff that goes on. So the government is running up massive debts by not taxing the rich, and the debts will never be paid back by the rich. The debts will be paid back by the same people who are paying the taxes now, the regular people. It's completely insane. It's like off the rails insane at this point. This will never happen. We have $20 trillion in missing Social Security, $30 trillion in Medicare liability, $128 trillion of total unfunded liabilities, and that's not even getting into infrastructure. And the top 1% have $56 trillion. See, the top 1% don't even have enough to pay the unfunded liabilities, but they do have enough to pay off Social Security and Medicare if you take all their money. The top 1% have $56 trillion. That's the key to the whole thing, though. I mean, that's 1% of the population has half the wealth. And anyway, so this is why Bernie Sanders is getting popular, because the kids who can do math, the ones who just went to school and actually learned math recently, they understand these numbers, and Bernie's people are explaining these numbers to people and saying, we can't keep going like this. You can't. You just can't continue this system. It's going to blow up. And the question is when, though. And so far, look, and then I'm saying this morning, which I said in the article today, I don't know if it was, what on earth is that? Wow, that's weird. I don't know what that was. Anyway, if you look at Japan, oh, I didn't have a thing for that. I had a cool chart for Japan. Here you go. Let's find that. Debt by country. It was a cool picture I saw that made it kind of obvious. Oh, here it was. Yeah. Okay. So this one, Now, this is percentage of world debt. Okay, so the United States holds 31% of the world's debt, owes 31% of the world's debt. Japan owes 20%, but their economy is only $5 trillion. It's a quarter the size of our economy. So that means that if you multiply that by 4, 80%, they're 80% to our 30% of the world's debt, well, proportional debt anyway. And that's about right. China, 8% of the world's debt. They're pretty much in proportion to us. That's, well, you hear all kinds of numbers from China. I'm pretty sure their economy is about half our size. It's not $15 trillion. People keep throwing that number around. I don't know where they get it from, but China does not have a $15 trillion economy. Probably about 10 to 12 trillion, but not 15. That's crazy. So basically, I'd say their economy is half our size. So we're in way worse debt shape than China, but on China, the corporate debt is completely out of control. And that's not counted here. This is government debt. You know, these are like some shocking numbers, though, especially when you look at Japan. But on the other hand, you can look at Japan and say, there's no consequences. How can there be consequences when Japan has 250% of their GDP, so roughly, let's say 12, 13 trillion dollars in debt, 250% of their GDP. That would be like the US having $50 trillion in debt. So what consequence? What's happening to Japan? What bad thing is how are they suffering from that? And if they're not suffering from that, then every other country essentially has made a huge mistake by not racking up the debt. Imagine the kind of growth you can have if you spend 10% of your GDP per year, like China does right now. China spends 10% of their GDP per year on debt. You know, I mean, grows their debt. So they're their debt's financing their growth by 10% a year, and their growth only ends up being 7%. Why? Well, because it's kind of wasteful. It's a very wasteful way to grow your country. You're not really improving things. You're just handing money to rich people and hoping some of it shows up in the GDP. You know, and China's doing the same basic thing. I mean, although they're doing a little more with infrastructure than us, which is also why their economy is growing much better than us. We're completely wasting our money. You know, when we put money into the economy, it's 75% wasted. You know, infrastructure spending is not a bad way to accumulate debt, because at least there's something in the future, at least 20 years from now, there'll still be a bridge. But when you just give tax breaks to rich people and give and allow low interest loans for corporations so they can buy back their stock. Buy their stock back from who? Buy it back from the poor people who are poorer than the corporation. You're giving the corporation the power to take back the ownership of the company so that less people own it. So it's no longer a public good. All this is going on now, and it's and Europe is a bunch of suckers with like hardly any debt. It's one of the reasons England wants to leave. They're like, screw this. Let's get on this. Let's start playing this game. Let's start borrowing money like crazy. See, even in this chart, which I don't know when it printed, but this is from 2017. Japan has a 239% to debt to GDP. Isn't that sick? And here's Greece. Greece is 274. Well, by 2060, that doesn't mean anything. So Greece doesn't look big, but in proportion to their economy, it's ridiculous how much debt they have. But this is the game that's going on. And so this morning I was writing about that and saying I like this a lot. This really, look, and I especially see this. I'm in Florida now, so I see this all the time. This is the gate, the wall, right? Which is why, this is why these people think building a wall is the solution to everything. A lot of them live in communities that are walled off from the poor people. But this is what you get. You get the rich people live here and the poor people live here. And this guy's house is as big as these 10 houses over here. That's how it works. This one person lives in 5 to 10 times more space than these people do. And all this stuff is really gonna hit the fan at some point, but God knows when. And that's what I say. So on the bright side, you look at Japan and say, well, there's no real consequences. You can keep doing this for years and years. We haven't even put a dent in how much money we can go into debt. the Fed, the ECB, the Bank of Japan, the Bank of England. Here's how much money they put in. Went from $5 trillion in 2000 to 35 trillion, or better, it went from 5 to 10 over one decade, and then in the decade since then, another 25 trillion. 5 to 10, 10 to 35. That's how much debt we've racked up in just the last 10 years. $25 trillion pumped into the, and these are just the central banks, though. Let's keep that in mind. That's not the government debt. That's not the US debt, which is another 10 trillion over the same period, basically. So that's, you know, and then you look at China's racked up debt and Europe has racked up debt. So you're talking 35, 45 from the US, another 5 from Japan is 50 trillion. You got the Japan isn't good for 5 trillion, so that's another 55 trillion. Then you got Europe and the Bank of England probably good for 5 trillion, so that's $60 trillion. That's just 4 central banks and their governments. And what have we gotten for it? What can we point to and say this is the result of this? I mean, we just have a highly inflated stock market, you know, and probably commodities too. Probably a lot of stuff probably shouldn't be as expensive as it is. Housing, you know, with housing, you don't buy a home, you buy a mortgage. You know, when you go to buy a house, you're basically say, I can afford this much per month. You don't really say I can afford $1 million home or a $1.4 million home, although, you know, the math is there. But basically what you're saying is that I can afford to pay $3,500 a month. Therefore, I can pretty much carry a $1.4 million mortgage. You know, that's the whole thought process in the thing. So there's a couple of things in housing. I mean, aside from the fact, so first of all, low interest rates artificially inflate housing prices. And we've had ultra low interest rates for a long time. So we don't know the real price or value of housing since nobody's paying a realistic rate of interest. It's all subsidized. Then you've got the other factor in housing, though, that's also keeping the price down in housing. So there's a little bit of balance, but property taxes are out of control. And that's the other thing. See, when you look at your monthly expense on a house, it's your mortgage plus your taxes. So when the taxes go higher and higher and higher, that eats into the value of your home. I mean, the home I had in New Jersey, one of the reasons we got out of New Jersey was because when we bought the house, the taxes were $3,500 a year, and 20 years later when we sold it, which is 20 years, but still $22,000 a year in taxes. That was more than our original mortgage. You know, $2,000 a month basically. It was more than our mortgage was originally in taxes. That's insane. You know, people buy a house, they think they're going to retire, and then by the time you retire, you pay off your mortgage, but then you've got this tax bill that's as high as your mortgage ever was. That obviously impacts the value of the house. The person buying the house from me has to say, geez, just to frickin' have this house, I had to pay $22,000. So probably half the value I could have gained in my home was stolen by the government. And you know what really sucks? They collect $22,000 a year, so they collected, you know, maybe they collected $400,000. But if they collected $10,000 a year, I could have sold a home for a lot more money, and I would have rather paid them 25% tax on the profit of the home than pay them every year and depreciate the value of my home. So people don't really look at it being connected that way, but I do. I mean, I see it's all connected. It's holistic, really. Everything's connected to everything else, and it's all the ways that we are running out of control. And why are we running out of control? Because you're because whoa, what happened to the debt clock? Oh, no, there it goes. I know I had it somewhere. Because if the government isn't collecting enough revenue, they then cut back on what they send to the states, and these states are $1 trillion plus in debt. Well, they're $1 trillion in debt, but they also have unfunded pension liabilities on the states of that, and local debt. Your localities are $2 trillion in debt. It's, it's completely insane. But anyway, so they don't have money, so what do? They turn around and hit up the homeowner. So you go like you're like, yeah, let's cut spending, let's cut the aid, let's not help the poor people and blah blah blah. But meanwhile, the burden of helping the poor people falls somewhere, and it ends up falling on the local municipality. Even if your help to the poor people is cracking their skulls open and kicking them off the streets, it's still something you have to deal with. Even if it's crime, you have to deal with it. We went through that in the 60s and 70s because we decided that we weren't going to help the poor people after they shot Kennedy. Nixon came along and said, no more helping poor people, let them get on their own feet, blah, blah, blah. And that was a spectacular failure, and crime skyrocketed. So then you have to now spend money to enforce the laws and police people and build walls and build fences because you're just surrounded by poverty, which goes back to this picture. And the funny thing is, these guys outnumber these guys by a wide margin. You got to pay not just to have these walls, but you got to pay to have the police to hold the batons to keep these people from crossing on the grass. You don't want them climbing the fence and playing with your children or something, So, or they all get a virus because they don't have health care. What do you think? It's not going to cross over the fence. It's all connected, and we act like it's not. We act like it's tough. It's crazy. And we'll vote down the school thing because these guys can go to private school, but these guys can't go to private school. But why should we pay for their school? It's like I hear that all the time. Because I live up by Paterson, New Jersey. And the rich people always go, I'm like, well, what are we paying for the school for? Do you know kids from Paterson come to our school and we're paying for it? And I'm like, well, yeah, if I lived in Paterson, I'd sure as shit go to my town too instead of theirs. Because the people would have all these different scams to try to get their kids into our school, which was nicer than Paterson schools. But these guys are sitting there being petty about like, oh, it costs us $1,500 per student, blah blah blah, and whatever. And I'm like, oh my god, really? It was like, and it was really like a total like 100 students out of 1,500 were like questionable origins, I guess you would say. But it's no different than immigrants. It's like trying to kick the immigrants out. It's like, really, you have to be that petty about stuff? But this is the world that we're in now, and we are pushing and pushing and pushing and making it worse and worse for the poor and better for the rich. And eventually something's going to snap, but who knows when eventually is. That's the thing. So until then, party on, and we can invest in so on and so forth. If we get past this virus thing, which I don't think we're past, we should have pretty smooth sailing this year. And I think I think Japan is going to be the canary in the coal mine. So when and if they ever start to collapse due to their massive debt and stuff, then we could start worrying about things. But until then, this is just going to keep happening. This is a new thing. I mean, the central banks and the governments will do whatever it takes to keep the prosperity flowing, so to speak, because we've been taken over by oligarchs at almost every level of government around the world, and those oligarchs want more and more and more money, and they want their own. It's corporate socialism. They want the corporate socialism. They don't want regular socialism. They want corporate socialism. Companies don't fail. Money keeps flowing in. Always get low interest rates. Always have cheap ways to refinance. You hear Trump speak. That's the bottom line on everything. It's like, I want low rates. I want this. I want business first. It's when he says America first, it's business first. And that's an oligarch. That's what an oligarchy is. That's what Russia is. Russia is an oligarchy. Russia is not a dictatorship. Russia is not anything. Russia is an oligarchy. And Vladimir Putin is the richest man in Russia, and he runs the country. And that's really what inspired Trump. I mean, not to be, whatever, but I mean, whatever you want to say about Trump kissing Putin's ass and all that, the bottom line is Trump was inspired by Vladimir Putin. Vladimir Putin became a wealthy, powerful man by being the president of Russia. That's how he did it. That was he used that job, and he manipulated everything to his advantage. And Trump's like, what a great scam. How do I do that? And he figured it out. He said, I can become president too. But they're, eventually there's a downside. But so on the one hand, I'll say like this is all going to blow up in our face at some point. But on the other hand, Japan, 250% of GDP in debt. We got a long way to go. And they will blow up first because they're not stopping. So, that's what we got to watch. And China, of course, this is scary. It looks like the virus thing. China this is just their corporate debt, not their government debt, but the government debt doesn't look much different. China, we still have this image in our brains that China is a debt-free country, but that's not true anymore because look at this. This is their corporate debt, and don't forget the government owns a lot of the corporations. They spent or borrowed $20 trillion to get from here to here. It's like $1 trillion something a year. So like all their growth, all the stuff that they do, all the building that they're doing all around China, you look there and you see crane here, construction here, blah, blah, blah. It's all based on $20 trillion worth of borrowed money. But in this world, you don't really pay it back. You don't owe it. It's not a thing. So what we're watching in China at the moment is how are they going to, they're heading into effectively a debt problem anyway. And as and the government's been trying to reduce the debt, but this virus thing has definitely derailed that whole concept. So the question is, in the next quarter, between now and the end of and next quarter when they start reporting, is that going to start getting out of control, or will the government make some kind of massive concessions to wipe these debts out or refinance everything? Hard to say what they're going to do. But if we can slide by that, that's what I see as the biggest upcoming issue facing the markets globally is going to be the China debt bomb and China's aftermath dealing with this virus that has shut down. About half the country is effectively shut down right now. And they're just starting to put people back to work, but it's been a 2-week break, almost 3 weeks of not working. And they're only coming back partially, and it still doesn't look good because I saw, let's see, China street spraying virus. Let me see if I can find the image I saw. Oh, well, apparently there's a lot of it. Well, I saw one with a bunch. Where is it? See this? This is what's going on all over China right now. Yeah, this guy. Look at this. This thing is spraying antivirals. These trucks are going up and down the streets in China. And I saw a fleet of them going around. And I mean, like 3, 4 abreast, and then like a group behind and a group behind that. And this is what they're doing. They're spraying these antivirals in the air. God knows what kind of damage that causes otherwise. And this is what they're doing. They're basically disinfecting entire cities, or attempting to anyway. Now, and again, it's a double-edged sword, right? Because on the one hand, wow, good, okay, it's good that the government's actually doing this, but on the other hand, wow, how bad can things be if they feel that they have to do this? This is extreme by any measure. Imagine the cost. I mean, I don't, I mean, it's not, what's that lotion you put on your hands? Anyway, it's not that stuff. It's not the stuff that you put on your hands for germs. This is a serious thing. Disinfectant, like that, disinfectant, more disinfectant. And this is their solution. They're just spraying everything down and being like crazy. But the fact that you think you have to do this is scary. And then and this is happening right now. Wait, what's going on up here? Okay. China's being virus, TRUCKS. I don't know where that one was. I saw it this morning, so I was like, that's what it was. It's a fact that it's happening right now. That this is going on today. And it was, like I said, it was a fleet of trucks going through the streets, totally empty streets also. And they are just still in a panic. But on the other hand, they're saying, oh, it's under control, or oh, we have a vaccine. That was all bullshit. Last week they said they had a vaccine. That wasn't true. It couldn't have been true. It wouldn't make any sense that it was true, but it doesn't stop them from saying it. So they're still not being honest. Excuse me. I knew I had to sneeze. Like it started sneezing, then I stopped. Oh, is this them? Yeah, look, there you go. That's the one. That's what I saw. Look at this. I want to see what I'm talking about. I wasn't kidding. This is going on. Fleets of trucks, all spraying at the same time, covering the city in whatever this is. And whether that's good for you or not, who knows? But it's better than this, right? And I understand, like, yeah, there's 1,000 people dead, but if there's 1,000 people, if there's only 1,000 people dead, how are they dying, like keeling over in the street like this? How is that under control? So anyway, I don't want to be an alarmist. I don't want to be like, I don't know if it's bad or good, but we are going into, oh, there it is again. So you are going to, it's crazy. You're going into a 3-day weekend, and it's possible that this is worse than you think. So I'm urging caution into the weekend. That's the bottom line of this. I'm urging caution into the weekend. We come back from this weekend and there's no alarming changes that we find out over the weekend. Good. And then into the next week, we're going to start examining the Chinese earnings. They tend to report later because aside from the fact that the whole country always has their holiday, and so all their earnings come in late, the Chinese companies, they also have obviously been closed because of the virus, so a lot of earnings reports are late. So we're not getting good information from Chinese companies so far about how they feel they're affected by the virus. We need to know that before we start throwing money into things. And it's not, oh, it's China, it's not America. These are connected companies that are going to have a ripple effect across the economy. And obviously we are ignoring it because we are at all-time highs. So you can't say, oh, we're taking this into account. We aren't taking it into account. We are ignoring the problem and pretending it's not going to affect us. And even though you have companies that are specifically telling you how it's affecting them, everyone's not an outlier. So we will see. But anyway, so that's what I'm saying. So I'm saying I'm not willing, although I do have a lot of longs I'd like to buy, I'm not willing to jump in and commit. We don't really need that. What do we need? Let's see how the market's doing. So meanwhile, getting bitten by the NASDAQ short, getting bitten by the ES short. We cashed in everything else. Oil cashed out with a 22 profit. Copper cashed out. I don't think you can tell what the profit is because if we cash them out, it only shows you the day. Copper was huge. Copper was like $4,000 or $5,000 profit overall because we started at 250 and we got to 260. And what else did we have? Natural gas. And then we had natural gas. And again, it's only showing the day's profit, but we started natural gas. Like last week, we started natural gas down here at 182, and we just hit 190. Or well, I'm sorry, we hit 190 there. We got out, and then we just got back in down here when it dipped again. Then we got back in. So since last webinar, which was back here, we did this at 180 something. We got out at 190, and then it came back down, and we came back in over here on this dip. And we bought a little bit more in here, and now we're out again, even though it's lower than where we were last time. It was just like it's, when you're behind on these are hedges. So what we did is we took the money that we made here and here and here has gone into this. And so, yeah, it's down right now, but still it's a hedge. And it can turn around very, very quickly. So the bottom line is we have pretty good protection. We have 4 of these and 4 of these now protecting the portfolio. So we'll see what happens. Let's see, we got questions. Jao says, aren't corporations people too? Well, legally, yeah, they are. but they don't pay, but unlike people, they don't pay the same taxes people do, which is very interesting. Let's see. Robin says, hi, Phil. I received an email important notice. You may lose your right to invest in leveraged inverse funds. I like the Lebu premium. How do you think the fund will be affected? I don't know what you're talking about exactly. That's the thing. I received an email notice. You may lose your right to invest in leverage and inverse funds. I don't know what that means. So is that some issue that we have suddenly? And when you say you, who is you and how does that apply to whatever? I'll take a quick look and see if it comes up. Investing in leveraged inverse funds. The risks of investing in funds, leverage, specialized, how do I invest? A list, top funds, how investors, I don't know. It could be a spammy email, who knows what it is. Oh, FINRA cracking down. Maybe that's it. Oh, I get it. So if FINRA's cracking down, maybe they want people to write and say, how dare you take away my inverse ETF, blah, blah, blah. Frankly, I don't care because there's really nothing, it's honestly almost to our advantage if you take away these ETFs, because then people would be more into SPY and it would be more liquid, and we can use options to gain the same leverage that people have. So in other words, like, look, I can invest, when we were talking about SDS today in member chat, so I can invest in SDS. See, ultra short on SPY is 2 times ultra short, and let's see where we are. So let's say we go out to September. So it's at 22. So if we bought the September, and today we were talking about the 23 at 185, and then selling the 30 at 80. So that's what? That's 105. I mean, it's a good hedge. Let me tell you something. I forget who found it, but it's a very nice hedge. I think it was Wilson's. So it's a very nice hedge for the money because you're at 23, and if it's an inverse ETF, if the S&P drops 20%, this will go up 40%. So you go from 23 times 1.4 is 32. So if you have the 23-30 spread for $1, that means for $1 you're getting a $7 upside protection, and if the S&P drops 20%, you're going to get that. If it drops 10%, you're going to get probably about 27, 28. So you'll end up with $5 or $4. Let's say you get $4. Even $4 is fine, right? If it goes to 27, that's perfectly good money too. So it doesn't take much of a drop in the S&P for you to get paid. So that's that. But let's say that didn't exist. Let's say we didn't have the opportunity to do that. If you only had SPY, okay, and we go out the same time frame, I wonder what I can do to fix that. Because, see, you guys probably can't see it, but this is the bar where I control the webinar. But I never, you don't use it once the webinar starts. And I guess I could try to put it somewhere else. Because I can never grab this little elevator on Thinkorswim when it's at the top. Anyhow, September. Okay, so now SPY is at 336. So what were we talking about? We're talking about what if the S&P drops 10% or something like that. So here, it's not very different because you can take the, if it drops 10%, that's $30. Okay, so really, you're not even talking about here. You're talking about these spreads down here. And so if it drops $30, 10%, it's going to hit $300, and that's going to be $560. And then we can go up here, $760, right? So the 312, 300 bear put spread is $760 minus $560, so $2. So it's $2 for the $12 spread. So in other words, what I'm saying is that there's ways you can set it up that are very similar. You can use SPY instead, and with the options, we don't really suffer from that. There's different, and obviously you can get, I'm just doing a simple example because you can hedge it closer to the money. I mean, we're at 336, so let's say you still want it to be at the money. So here's $14 here, and 326 is 11. So it's $3 for the $10 spread. You know, not quite as good, but it's there. But also because you're not playing the leverage. If you go further down the line, like here's 7 at 308, and here's 9 at 319. So that's $11, and you're paying 2. So you know you're kind of not far off where you would be otherwise. And you're using SPY, which is way more liquid. You're paying less of a spread generally, and it's easier to get in and out of quickly. So you can use it a little bit better because since you can get in and out of it quickly with low friction cost, you can actually take advantage of a quick move more so than you could on the inverse ETFs. But anyway, so they want you to. I imagine what this means is somebody wants you to write protest letters and so on and so forth, so that you can keep using your inverse ETFs. I love them. In fact, Leibu, I was just noticing that one because Leibu was one we picked as a that was a top trade. That's what came. It came up today because it was one of our top trades. And let's take a look at that. Oops. Top trades. There you go. We just added SKT today as a top trade, and I'm pretty sure that Leibu is way down, page down. Let's actually look at the top trades for a minute. So Discover Financial, right? Hasn't probably moved yet. No, so it's still down. Good for a new trade still. Viacom. What happened to Viacom? Viacom's still down in the dump. Still good for a new trade. What are they called? Middleby? I forget what they're called. Anyway, whatever they are, they started to move already. I like Middleby, right? So Middleby, I like them. They make Viking ranges and all kinds of stuff. But the reason we wanted them was because there's a rumor that they're getting an account from McDonald's to launch the McDonald's crispy chicken sandwich. That their particular oven is good for that, and that's what they're going to go with. I don't know if it's true or not, but it's just a reason to buy them at the bottom. I mean, that for me, it's like I like these guys because they make Viking, they make a ton of other commercial cooking ranges and so on and so forth. It's a good, solid, consistent company. It's like people, it's restaurant supplies basically. So they're really good. And whenever they're down low, I kind of get interested in them again. So on January 17th, which was down here, I said, in fact, this was the day that we got them because I saw this and I said, oh shit, I better grab Middleby. They were on my list of potential buys. And as soon as I read this news item, I said, we better get it before it pops. So as I said, it was on the low end of the trading range on the day they wrote this article. And we jumped in it right then because I saw that news item and said, oh, let's grab it. And we took the 110, 120 spread, and now it's popping back up. That's like free money. This is how the rich get richer, though. I mean, we get to take advantage of these kind of things. IMAX, I cannot possibly stress enough how good IMAX is at this price. In fact, I was just talking to a friend of mine today who's a Hollywood guy, and my Hollywood friend said my logic is right on IMAX. I said because it just happened to be speaking of stuff. I said to him, I said, look, I said, Jamie, my premise is that, because he's a filmmaker. So I said, look, I said, my premise is that all you guys have been using IMAX for like 20 years, and all your budgets for the next 5 years are using IMAX. The people who use IMAX, not everybody does. But I said, all you guys, when the big pictures come around, it's like everybody's got a budget that has IMAX. Marvel has their movies planned out for the next 5-year cycle, and they know which ones are going to be in IMAX and which ones aren't. You have to reserve the cameras 3 years in advance. There just aren't enough of these things in the world for everyone to use. Then when you release it in theaters, IMAX has 1,000, 1,100 theaters around the world. And even if somebody started building tomorrow even if you start building theaters tomorrow, it's something that competes with IMAX, and you start pushing them up like as fast as the Chinese build things or something and put them everywhere, it would still take years and years and years to get to 1,000 theaters around the world. You have to, you got to knock down things and do stuff. IMAX has been doing this for a decade, for decades. You can't just start tomorrow and do it, because IMAX already took advantage of all the old movieplexes that wanted to be knocked down, and all the small theaters that wanted to push 2 and 3 screens together to make one big one. IMAX already did all the cherry picking on those. There aren't that many people left who have misallocated screens and such. So it's their distribution already, the number of theaters they have, the acceptability of the format, the use of the format by the directors. Now, if you're going to do a $300 million movie, let's say, even if it's like Dolby, and they say now in Dolby Vision, right? Even if it's in Dolby Vision, if you're making a $300 million movie that's got to make $1 billion worldwide to be considered successful, are you going to go to Dolby Vision and shoot your movie in that instead of IMAX, which has the potential to do $1 billion in business? No, there's no way. You're not going to risk it, and that means that they're only going to play to the low-risk films, and that means the theater owners won't get their money back. Blah blah blah. So again, holistic. It's all connected. And you have to think about, like, how is somebody going to beat these guys? So whenever IMAX sells off, we jump all over it. We jumped all over these guys. I love them. And this is a crazy low price. Even today, even with a 5% gain, crazy low price. So that was a top trade back when it first fell down this low. January 15th was here. So we're not even back to where we started. We've already increased this trade, but we are not even back to where we were January 15th. I'm happy at 20 with IMAX. It's down to because of the China thing, it hit 17. So I cannot emphasize enough how much I like this trade. H&R Block also still low, and we like them because people tend to not think about them until they start doing their taxes, and then all of a sudden everybody's like, oh, H&R Block, yeah, that's a good one. So we like them down here. Toll Brothers building. Well, let's see. We started talking about Navy. Oh my God, look at that! Holy shit, that was a good call. The 16th of December. So somewhere down here, we like Toll Brothers, and now they're back up to 30. So good for them. I'm sorry. No, here. Holy cow! How did that even happen to them? Okay. Anyway, so that's obviously gone. TD Bank. That was crazy. So we like them. I'm sure they're much higher now. Oh, not much higher, but they're still playable, really. Yeah, that's not so bad. So TD Bank was when? December 12th. And that's when they were around here. So they're basically they haven't moved very much. Like them down here for sure. Macy's again, because I always pick Macy's because that's been going on all fall. Like, Macy's. So I said December 9th around here. I'm like, Macy's again, because for God's sake, how many times can you see this thing at $15 and not buy it? Chipotle, we did this crazy shorty sort of thing in the portfolio. That's working out. What was I trying to find? I forgot. I don't remember. Okay. Vail was from December 2nd. They're quite a bit up from December 2nd. Well, no, I'm sorry, they're not. They're basically back down from December 2nd. So that's still playable. X. So US Steel. Oh, US Steel got way worse. So that one's still playable for sure. LB finally took off and out. So from November 25th. Oh, that was a good call, huh? So November 25th, and now they're gone, so you can't have them anymore. Somebody, it looks like they're going to be taking, they're selling the Victoria's Secret brand to somebody, but who knows what happens after that. TAP, that's Molson's, and Macy's. Oh, that's why I said Macy's again. So we had Molson Coors and Macy's again. It looks like Molson Coors just had some bad earnings or something. They were really taking off, but they came back a bit. That was from November 19th, so we're still in okay shape on that one. We were following the MJ ETF, that's still cheap. Macy's again, always kept picking it down there. China Mobile, CHL, they're, when was that? November 15th. So they were here and now they're up here. And we just picked them again for another thing that we did. Philip Morris, I decided they were getting overhit, but I guess I'm wrong. So this was November 8th. So they were down around here and now they're back to where they were. So not looking so smart now, but we bought them for the dividend portfolio. So when in fact, actually, we sold the 40 puts, we sold the 47.50 calls, which is right about where we are, or 45. And it was looking good, and now they went down again. I think they probably did another write down on their new earnings. NLY, that's another REIT we like. Dividend portfolio trades. That's all the stuff that ended up in our dividend portfolio, which has been doing fantastic. iRobot, we got back into. They haven't gone anywhere yet. October 22nd. Damn, what was the one I was thinking of? I was looking for something. The MJ again, the ETF, we like it down here. I swear I just said something when we were looking at it. Oh, SunPower, that was a good call. Oh, we were liking gold. You know, this is funny. When you read something like this, China gold purchases top 100 tons during the trade war. You read this article, and it's October of 2019. So we're over here. No, I'm sorry, we're not over here. We're over here. So in October 2019, we read this article, and I go, maybe it's a good time to buy gold because China has added more than 100 tons of gold to its reserves. Blah blah blah. I don't understand. How is it so hard to make this connection? Russia is also adding substantial quantities of gold. Central buyers have been buying gold, blah, blah, blah. How much more clue can you need that it's a good time to buy gold? It's just freaking read the news and do something. Leibu, that was it. I knew it. I knew he added them at some point. That's what we were looking for. So it was way back on October 3rd. Look at, oh, that's TNA. Why am I looking at that? Way back on October 3rd. Holy crap. What a freaking call. It's an ultra long biotech ETF, and you know, and again, it's like biotech is where we get back to that stock of the future thing. It's like, of course, it was a good thing to buy when it goes that low. The whole biotech industry isn't going to crash out, although the marijuana industry did, so you never know. But you know, it seemed like a good play at the time. And look at these prices. We bought the 30-45 bull call spread. We have blown through that target. We sold the 25 puts. That was a joke. We sold 25 puts for $11. How could you not want this trade? A $640 credit on a $22,000 spread. Holy crap. So I guess that's the trade you're looking for. So that was a long way to get to this question, which is, I guess that's the trade you're talking about. And you know, I like the Leibu premium. How do you think the fund will be affected? Thing. Okay, so anyway, so you know, I don't know if they're going to regulate these things out or what's going to happen, but you know, obviously you want to just keep an eye on that as far as if there's any changes in the regulations. We had Texas Instrument and TCNNF. I know Texas Instrument's doing well. TCN, and again, this is just my normal pattern. A bargain stock goes on sale, I'm jumping over it, and then we just wait for nature to take its course. I don't know where TCNNF went. McDermott and cash. Yep. We decided to get out of that one. Sugar, oil, these are so old that you can't really even look at them anymore. Though. Anyway, so, you know, oh, wow, look at that. When was this? September 19th. Okay. September 13th. So that was back, who knows where it was then. Oh, sugar at 10.50. Look, it's up 50% since then. You know, and again, this is a thing. All we do is just pay attention. Sugar got crazy cheap. Unless you see some reason that people aren't consuming sugar anymore, you say, God, that's kind of cheap. It'll probably come back at some point. You know, commodities wax and wane, and cyclical stocks wax and wane, and they go up and down with the time. IMAX could go way up because, you know, 3 movies in a row are hits and they have a great quarter, and they can go down because 3 movies in a row are dud and they have a bad quarter. Because IMAX, it's not up to IMAX whether or not people go to the movies. They don't know that Joker is going to be a hit, and that Birds of Prey, which is currently in the theaters, they don't know that that's going to not be a hit. Who can explain why? I mean, it's such a weird thing. It's because there's, you know, they're both in the same theme. They're both DC kind of movies. They both feature characters. Harley Quinn is a Joker's girlfriend. I mean, and you could say, oh, that's a stretch, maybe not, but I don't know. I really like the Birds of Prey, but that's beside the point. But I mean, I didn't like that Joker movie. I didn't think it was that good. I thought the Joker in Suicide Squad was better than the Joker in the movie The Joker, but they gave the award to the Joker, so what can you do? Anyway, it's you don't know what movie's going to be a hit and what movie's not going to be a hit. You just have to play the percentages on it. But IMAX isn't per se losing money when the Joker isn't a hit. IMAX is, or I'm sorry, when Birds of Prey isn't a hit, they're just not getting as much of a revenue cut as they had possibly hoped for. And obviously, if that happens over and over and over again, that's a problem. But what are the odds? People tend to go to movies plus or minus 10% of the in a good or bad year. You know, the same amount of money, which I believe is $4 trillion, is spent on movies by the public, maybe 3.6 and maybe 4.4, but that's going to be your spread. But one way or another, people are going to go to movies. A percentage of those movies are going to be IMAX, and blah, blah, blah. And more IMAX, I think the biggest problem with IMAX right now, maybe it's not a problem, is that there's so many IMAX movies now that they sometimes have an IMAX movie that's only in for 2 weeks. It used to be an IMAX movie would run for like a month, you know, because they wouldn't, they wouldn't have another movie coming that quickly. Now they literally have on holiday weekends, they'll have an IMAX movie and then a different IMAX movie. And sometimes IMAX has different showings to accommodate the fact that more than one movie of IMAX was made at the same time. And I just don't think that's good. I think it was better when you used to have time to see it, because you know how it is with a movie, like it's too crowded the first weekend. So you're not going to go to the IMAX because now you have a limited amount of seats at the IMAX. You have very little chance probably the first weekend of going to the IMAX and seeing it. So then the next weekend, maybe you get around to seeing it, but if you don't see it and it's already out of the theaters after 2 weeks because another movie comes in, you just miss seeing it in IMAX. And the thing is, you can see it somewhere else. You can see it on a regular screen. So it's not like you're forced to make sure you see it in IMAX, although obviously people have a preference, but you know, your preference isn't that you're going to miss it entirely. You get to see the movie on a regular screen instead. So I think that's detrimental to IMAX that they're so quick to pull a movie off the IMAX screens. And it's not their fault. It's the scheduling of the theaters. They've got an IMAX cinema and they decide how they want to do it. They want to have the most full weekends. But I think some of that lagging, you know, some of the also rans of people coming in is probably diminished by that. But again, on the whole, does it hurt them? No, not that badly, and certainly not to knock their price down like it has been. All right, let's see if we have any more questions. If not, I can just keep rambling. Carl says, does Joe still look good? Oh, wait, another Joe says, a problem with the video and volume, are you still online? Can I answer him? I'm still going. try restarting. Whoop, did that work? Send privately. Nope, send to all. I don't know. Okay. Oh, I didn't want everyone to try restarting. Ah, man. Okay, well, hopefully you guys figure that out. All right. So Carl says, is Joe still looking good? The coffee ETF. So let's go take a look. And we don't look at I don't care about the ETF so much as I care about the futures chart. So let's take a look at softs and we'll look at coffee. And yes, if coffee's at 100, it's in the buy zone because same thing with sugar. There's a certain price of a commodity at which the farmer no longer makes money. And of course, obviously it's too late if they've already planted crops. But as long as you can afford to stick it out for the long haul, then this becomes a good entry point for coffee because it can't really go that much lower. And I know the natural gas, now see, natural gas is different than coffee because natural gas, there's been such a rush of natural gas to produce it that God forbid the demand isn't there. They just end up with a bloat of natural gas. Now that's a seesaw because they open up more LNG export facilities, which compresses the natural gas tremendously, and they export the natural gas, so it takes up a huge amount of supply. But then if those facilities aren't built on time or they don't put new ones online or a pipeline doesn't get completed, then the natural gas ends up being stranded somewhere. And stranded somewhere means in America generally, and the natural gas prices plummet. Coffee is not quite like that. Coffee, obviously, they have to sell what they grew already this year. They got to, whatever price they get for their farm goods, they're going to have to sell them because it's going to, otherwise, what are they going to do? Let them rot? You can't, I mean, so you're going to sell the coffee for whatever price the market will bear. But next year, you're not going to go through the whole hassle of planting coffee. Farmers change their crops all the time. Now, of course, coffee grows specifically in certain regions and blah, blah, blah. It's like saying the grape guys aren't going to plant their wine. They do that no matter what, basically. They don't always know what they're going to get for it. But still, you actually have farmers who can't afford to plant anymore. When you get down towards 90 or 95 even, you have farmers who simply can't afford to plant coffee at those prices. They can't afford to be in the business anymore. So farms will close or things will happen and supply runs short and so on and so forth. Starbucks has to deal with this all the time. They actually have to try, they have all these programs to support the farms and try to steady things out for their suppliers because they deal with a lot of small scale farms. Anyway, so yeah, anything around 100 is a good place to get into coffee. It might go to 95, it might even go to 90. So you have to be able to withstand the pain, but on the whole, it's good. So now we look at the ETF Joe and we see how they've been affected. Oops, not Jew, Joe. And wow, look at that. Huh. So they got creamed. Creamed, get it, coffee cream. Anyway, so they got creamed. And they're about as low as they were at the beginning of the year. Now, here's the thing, though, you have to consider. Coffee. So in May, coffee was 90. And Joe was, where was I? There. Okay, so keep this in mind. May, coffee was 90, and Joe was 30 and 50, basically around there. So now coffee's 100, Joe's 32. So basically, you could go down to like 30.069, but obviously didn't last very long, but that was the absolute low down here. So let's say that 30 is the low for Joe that we would expect. Now, can we construct a good play? And I get most excited about a play if I can play the very bottom that I think it'll go and still have a nice play. So it only goes out till September. I can sell the $30 puts for $1.50. That's always a good start because I really don't think it's going to go below 30. So we can start by doing that. And let's say I sell 10 of those for $1,500, right? That obligates you to buy 1,000 contracts for 30 though. So you have to be able to execute that part. But if you do it, that's not a bad way to start. In fact, if you sell 10, it's not a big margin thing. It's also, if you have a margin account, it's the way you want to go for sure. But if I sell 10 of these guys for $1.50, then my margin requirement is $2,000. So that's how we want to start that off. And then as a trade, we don't think it'll go below 30, but we don't want to spend too much money. But here I see, so then it becomes a question saying, okay, at 30, it's 450. At 29, it's 510. So that's 60 cents. Here's 580. So that's 70 cents more. 580 to 650 is 70 cents more. So really my sweet spot is probably stopping around 29, but the 29s are not going to be very liquid. So I'm going to go to the 30s. So I do want to be in the 30s, which is still 260 in the money. So I want to buy the 30s and sell, and now I watch where the diminishing returns are. I sell the 35s for 235, I guess. So what do we say this was here? 450 minus 235, so it's going to be about $2, a little bit more than $2. If I sell the 36s, that's going to give me 20 cents less, but a bit more headroom. And if I sell the 37s, now it's getting expensive. So I think here, so let's say I can do these guys for 210. No, it won't be 210. Let's say 205. So 205 for the 36s, 445 for the 30s is 240 on the $6 spread minus. Now the question is, do I want to do 10 over here and minus $1.50 from 240, or do I want to minus 70 from 240? And that goes back to now how good do I feel about this trade? And so now I want to go back to coffee again, not coffee, but Joe. And I want to say, do I really think 36 is doable? Oh yeah, I definitely think 36 is doable. Is September a realistic time frame? Well, September sucked this year. It came back to here, but it wasn't huge. And last September also bottomed. So it's not a good time of year, really. I'm not too happy about September. It looks like we might be better off. Well, this September came up. It's a little tricky though, right? Because it came way down, way down, way down. And now it's way down again, much more so. See, it came down so quickly here. So based on that, what do I think? So now I got to think about this. We can do the 30 shorts, not worried about that. We said we can do the 30 calls, but is it really going to get to 36? No, I think I'd rather sell the 35s given that. So let's say 235 here and 450 here. So that's $2.15, and I would only do 10, and I would subtract these guys for 150. And that's going to be 65 cents. So you're only spending 65 cents. So as long as you're over 30 by 65 cents, you're going to make money, and you make up to you get up to $5 back, which would be a $4.35 profit, which is a nice profit off 65 cents, but you're just going to have to do a small batch. So that's the way I would play it. I would just play the small batch. If you do 10, 10, and 10, so you sell 10 $30 puts, you buy 10 $30 calls, you sell 10 $35 calls, and your goal for September is 35, at which point you get $5,000 back off your $650 investment. So it's a profit of $4,350, which is, I don't know, 700%. So it's not terrible. It's not going to be a huge amount. I wouldn't take a big risk on this. There's a good chance you may have to roll it if the coffee season is a bust. If you have a lot of pressure, you may have to roll out to January next year. You may want to roll out the other calls to next spring, and you'll be down for quite a while in a long position. But when I start off, we're going to make 700%, and I fall back to make only 200% on a bigger position. I don't consider that the end of the world. But again, it goes back to your budget, because if I budget incorrectly, there shouldn't be more than like 5% of my portfolio at most. So a position like this, 5% of my portfolio, if I have to wait to turn 5% into 15%, I can wait. I can be patient for something like that. But that's the point. You've got to be planned out, and you've got to know how much money can you make. So how much money can you make on this trade? Is it going to be worthwhile to stick with, and so on and so forth? That's what you want to be thinking about on every trade. Hopefully Joe's back online with us now. And JC says, note coffee trees take 4 years to bear fruit after planting. When prices are low, farmers may not plant more trees, but their existing trees are still bearing and they therefore need to sell the beans no matter what the market prices are. So that's a good point. If you see coffee consumption numbers dropping off, that number one, if coffee consumption numbers go up, they can't grow coffee fast enough to sell it, to meet the demand. So if you see new forms of coffee consumption coming online, that may indicate an upcoming shortage. On the other hand, if for some reason coffee consumption goes down, which I don't think it has in a very long time, then it would take a long time for farmers to catch up. But those are the kind of cycles we love, because it takes, you can then see like, oh, this isn't going to be any good. They can't fix this. Or if you see crops wiped out, I think coffee for me is mostly an environmental play. To me, it's like global warming is causing disruptions in all sorts of crops. Now, coffee crops, very fragile, very hard to fix, as Joe points out. So therefore, if there are any major problems in coffee, that it can cause prices to spike very high. I just want to be here if that happens. Same thing goes with my natural gas place. I just want to be around if it takes off. If it doesn't take off, so what? We'll just see. But if it takes off, I would like to have something in play at that time. So how are things going? Oh, there's Joe. We were looking at Joe like, does it do that? Because I talk about it, can't possibly. But were we looking at Joe last week? Did it also come up last week? I don't remember that. So weird. I remember last week something else was up there, and I said, how come? Is that because we talked about it? It's so strange. So oil's up, Brent is up, gasoline's up, natural gas really taking off. Copper flattened out. We got out of these. We got out of all the commodities. Gold and silver, people are getting less worried about the virus. Dollar's up, dollar's way up, very strong. And Apple's pushing things today. Apple is having a good day if I can find it. Don't forget, Apple is a massive market mover. So when Apple's up, 2% like that, it's pushing the NASDAQ up, it's pushing the S&P up, it's pushing the Dow up. 5.5 points on Apple is 45 points on the Dow. So about 20% of the Dow's move today is being caused by Apple. Oh, it's funny because CNBC is right now talking about the coronavirus impact on Apple's growth. So we'll see what happens there. Anyway, so we talked about the top trades. There's plenty, it's why it's always good to do these reviews and look back on stuff. There's plenty of these top trades that are still playable. And I didn't see any of them I don't like anymore. So that's one way to go back. Also Friday, I think it was Friday, maybe it was Thursday, find out. Maybe it was last week in general. We were talking about a lot of trades that we thought were still playable. So like I said, if we clear into next week and the holiday is good and we come out of the holiday and things are good, in fact, next week's webinar, we will be discussing trades that I want to, let's start talking about longs and looking at a lot of longs for the long-term portfolio. So here's Friday. Looked at Aurora Cannabis is getting killed still. Wow. Oh, I said TCNNF has no options, but I like them at 10.15. That's Truly, which is a Florida distributor. I don't know what they're at now, but it's not really important. Wait, no, that's not it. See if they're still down there. TCNNF. Nope, same price. So this is True Leaf Cannabis. They make money. They're being investigated by the FBI because her husband, Kim's husband, she owns a company, is involved in some kind of a real estate scam, and he's obviously an officer in this company too. And so they're investigating everything because, and then of course there's certainly the danger they could lose their license if they were both caught up in this thing. They lose their marijuana license, they're screwed. but it's not very likely to happen. But the threat of it happening is really killing the price of this stock. But I like him, and I think even if they lose their license, they would just have to flip it to somebody who could be licensed and continue the company. So I think that's a little bit overdone, all the panic on that company. Uber has been kicking ass in the last week, crazy. I was gonna, yeah, that's a good one to talk about. Where is that? Uber. Ugh, because I don't see it. I mean, I know the potential's there, but $70 billion. $70 billion, billion, 14 billion in revenue. Even if it was all profit, it's just not. I mean, 50% profit. These guys are not making money. They did make $1 billion here, so they could make 10%. But if they make 10%, they have to get up to 70 billion in revenue, or let's say at least 35 billion in revenue, and drop 3.5 billion to the bottom line before $70 billion becomes an attractive valuation. That would be 20 times earnings at 3.5 billion. But they're not doing that. They're losing. They lost $8.5 billion in 2019. They're going to lose $3.5 billion this year. And people think that's great because they're losing less. I mean, it's a madhouse, as Charles Heston said in Planet of the Apes. It's crazy. They are throwing money at the most ridiculous stuff now. These guys made money once, but so did Tesla. And Tesla's worth even more, right? Tesla's worth 130 billion or something, 140 billion dollars. Because they're up today again. At least Tesla might make some money. At least they're projecting profit. A lot more, they get a lot bigger valuation. They double Uber, but at least they're making 2 billion and not losing $2.5–3 billion. That's a big difference. There's something there. And again, I'm not a big Tesla fan, but there's something there. You could hang your hat on some kind of potential earnings. In Uber, no. All they're doing is saying we might lose less than $3 billion next year. Not this year. This year they're going to lose $3.5 billion. Next year they might lose less than $3 billion. And what does Uber actually have? They are an app. They have customers and they have drivers, and the app connects the customers to the driver. As a customer, my loyalty to Uber is effectively zero unless they keep putting out a product I like. If Lyft were cheaper, and they are cheaper actually, in my area, Lyft is very consistently cheaper than Uber. So if Lyft is cheaper, or if it provides a better service or whatever, I will start using Lyft and dump Uber because there's no friction cost for me as a customer to not using Uber. And you always have to realize that about these appy sort of things. Tesla. If Tesla can get me to buy a Model 3 with a fast charger, then when I go to buy my next electric car, my first thing I'm going to say is, does this work with my Tesla fast charger? Because, if it doesn't, then I wasted my fast charger. I had to go through that whole thing again and put another installation or whatever, or get adapters and something. Maybe it's a big deal, maybe it's not, but that's going to be a concern, right? So there's a friction to moving from Tesla to something else. And then then there's the thing to be wrapped up in a brand identity, blah, 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 whatever. So you can generate customer loyalty that way. It's hard to generate customer loyalty to a service business. Okay, because you don't have a relationship with your Uber driver. Your Uber driver is a random guy who picks you up. The chance of getting the same guy twice is not that heavy. So where is the customer loyalty? The customer loyalty would have to be to the brand Uber. And that's always only one bad story away from becoming a liability as much as it is a positive. And you know, Lyft too, obviously, but I'm saying there's no real friction cost to that. I delete the app, I open up the new app of whatever kind of you know, of flying taxis, let's say. Yeah, let's say some flying taxi company comes in and smokes Uber. You know, flying electric taxis are only priced 50% higher than Uber, but I get in a taxi that takes a droney taxi that picks me up, takes off, and goes somewhere, and I'm there in 1/10 the time of what Uber does. So what am I going to do? I'm going to switch, obviously. And I'm not going to go back. So then Uber has the pressure to be the flying taxi company, and they can't let themselves get beat. This is a problem, by the way, for corporations like that. You have your market share, but you can't afford to get beat in your market share. So therefore, even if it's stupid and even if it's too far ahead of the time and it's not ready yet, Uber still has to be the leader in flying taxis. Otherwise, they run the risk of completely getting blown out of their market by flying taxis. So they end up, this is what happens, because then companies like Uber will end up spending stupid amounts of money before things are ready on projects like Google did, right? Well, like, you know, Google, I know they keep just going higher and higher, but the reality of Google is they invest in a lot of stuff that just never works. But they can't afford not to have the newest and coolest stuff because that's their brand. Something new and cool can't come out of somebody else. Bing can't release something amazing. Google can't have that happen. So that's the way it works. It works for Uber, it works for them, it works for Tesla too. Tesla's got to be the coolest electric car, and if somebody's going to put out an electric truck, it better be Tesla. If somebody's going to. Speaking of trucks, whatever happened to Tesla's truck? I love how they announce stuff and it never ever happens, and nobody holds them accountable to anything. It's just so weird. They showed us trucks like 3 years ago. I haven't seen a single one actually on the road. So anyway, so Uber's got to have, if there's a truck, they got to have a truck. If there's a pickup truck, they got to have the pickup truck. If there's this, they got to have it. No matter what it is, Uber's got to, not Uber, sorry, Tesla's got to be able to show it to you. And Uber has the same problem. If it's got something to do with people getting moved from one place to another in a shared service, Uber has to be in it, even if it's stupid, even if it doesn't sound like it makes sense, because they can't afford the chance that somebody else is going to take it and pass them by. And that means they're going to spend a lot of money. Companies like that end up spending a lot of money on R&D and on things that maybe aren't smart. And down the road, they could even make a merger that's stupid. You got to be real careful about things like that. Speaking of mergers, IBM bought Red Hat. That was a great move. Whew, that's working out for them. IBM, how are we looking? Love it. My last year's start. Oh, look at that. That's the earnings. Red Hat acquisition paying off already. And I can take you back to it, but when acquisition happened, I said that's freaking brilliant. And why was it brilliant? Because where was IBM failing? IBM was failing in getting into new businesses. What do new businesses do? New businesses use Linux because it's cheaper. And as they grow, they want to grow, but then they grow out of Linux and they go to Oracle or Microsoft or IBM or somebody else, right? They go to several other places when they grow out of Linux. But now IBM has captured Linux. Red Hat is effectively most of the Linux market. So now small businesses are already secretly working with IBM. When they go to free Linux and they start up, they are starting with IBM, and IBM can target them and track them and transition them, and it's a foot in the door for their salespeople that puts them ahead of their competition. And that's why they bought Red Hat. And nobody understood that when it happened. I was like, that's why IBM was our stock of the year last year, because they bought Red Hat. And we thought that was a brilliant move. And IBM sold off on it, and we were like, sold off? What are you, crazy? Where was that? Yeah, so here in November, this is when IBM bought Red Hat, and we were like, are you kidding me? So we took IBM, and that became our stock of the year for 2019. So that's worked out well. Of course, it's a 2-year trade, but we already cashed it out here in September when we cashed out our portfolios, and now we're back in it because it's obviously came down enough where we're like, oh, we'll jump back in that. Sure, you want to give it to us again? It's crazy because people don't understand it. Now they understand it. Now I don't think it's ever going to come down again. I don't think you're ever going to see these levels again, because now people are like, oh, I get it. You know, it's like, oh, that's why you bought Red Hat. Because everybody's like, oh, Red Hat, they don't make enough money, and what is IBM doing, and how are they going to monetize it? You don't have to monetize it. IBM is all about selling you big iron, and if they can sell you big iron, they don't give a crap about the Red Hat thing. That's a free software giveaway as far as they're concerned. They don't care. If it builds a relationship with your IBM salespeople while you're a young company, and then when you are going to transition, that's the first guy you're going to talk to about transitioning to the high-end servers and stuff. That's a home run for those guys. So that was brilliant. Well, speaking of brilliant, Disney. I'm going up to Orlando this weekend. Disney, $200 a day to go to the frickin' theme park. A family for Disney is no longer for the bottom 50%. The bottom 80% really is no longer able to go to Disney. It's not for them anymore. This is just going to keep projecting up and up. They got the movies, they got the Marvel, they got this, and their theme park revenues. It's because they can't fit any more people in their parks. It's full. And they raised the price to $125 just like 2 years ago. They were at $125 from $100, and people were like, holy shit, $125. They hit $100, and people were like, crap, $100. Then it was full, and they went to $125, and then they started doing surge pricing, and they found out that even the surge pricing doesn't keep people away. And it doesn't, because, you know, I'm flying the kids to Orlando, and we're spending $400 on airfare for each person, so that's $1,200. We're staying in hotels that are like $300 a night, and let's say that's for 5 nights, and that's another $1,500. It's a $3,000 trip before I go to the park. And then the reason they charge $200 for a 1-day pass is because that way, when they tell you it's only $400 or $350 for a 3-day pass, you're like, oh, thank you, Disney. Oh, wow, that's so wonderful. What a great discount. And you suddenly are forking over another $1,000 or whatever for family of 4 to go to the theme park. Well, let's see what Disney 3-day pass. $175. Oh, it's Florida resident. No, forget that. I get that. You don't. Disney 3-day pass. Disney. Here you go. Disney tickets. Theme park tickets. Come on, admit what you did. You know you did it. Disney World, DisneyGo.com. That seems official. Oh, Florida resident again. See, if you're a Florida resident, you get all these great things. Prices and products for all guests. Oh, the longer you do. What? I don't understand this. One park per day. God, they're all over the place. I don't get this. If that's the pricing, I'm thrilled, but I swear it was a lot higher. It's official ticket center, Disney World. They keep talking about Florida info. Anyway, all right, well, it's not really worth it. But I mean, seriously, I certainly saw. Oh, well, here you go. Disney $200 tickets. There you go. I knew I saw that. So Disney, blah, blah, blah. Rest of the California pay in California. Disney Park Wednesday, reveal on-demand pricing. Disney now offers 5. Oh, that's their most expensive ticket. California Adventure, 1 day will cost between $159 and $209. 2 to 5 day hopper tickets. See, that's what I'm talking about though. By raising the prices here, they make this sound reasonable. $350 is still the price of what I was thinking. Quiet you. So anyway, they have all this crazy stuff, but that's the way it works, because when you go, you guys have been to these things. You go to the theme park and they show you these sticker shock prices, and then they say, oh, but we can work this and that out for you, and whatever. And like I said, the Florida pricing is fine. I mean, the Florida resident pricing, thank God, is not crazy. But it's just insane. It really is. I mean, the amount of money they think you're going to spend on these things. But anyway, so good for Disney. Oh, and why? I remember what I was going to say. So Disney park attendance. Total of 52 million people. So Disney World. Okay, 20 million, blah, blah, blah. Okay, all right, so total Disney of all parks is 52 million people. In one park, 20 million people. Now, that's Disney World, obviously the biggest one, but there's 8 billion people in the world. So if 8 billion people in the world go once every 100 years, that's 80 million people a year. So if everybody in the world goes to Disney once, that's more people than they can fit in the parks. And then obviously, that there are people going to Disney multiple times, and that would be every day. So don't forget, that's if you only go 1 day in your life. If everybody in the world goes 1 day in their life, that would be 80 million people a year. So that would be double what they can have. Now, of course, half the people in the world are certainly too poor to go to Disney. So there you go, you knock out that. So now you're right about the right prices, the right numbers. But that's still only 1 day. Of those people, you have people who can afford to go to Disney multiple times. My children have been to Disney. Oh, I would be hard pressed to think of a year they didn't go to Disney in their lives, and they're both in college now. So they've been, I'd say 3 days times 20 years. They've been 60 times to Disney in their lives. That would be my best guess. But I obviously top 1%. But the point is, people in the top 1% can go, I would say, every 5 to 10 years when they have kids anyway. So their kids will go 2, 3, 4 times with the family. And that right there, though, is the top 5% is going to be, I'm sorry, the top 1% is still going to be 80 million people who go 10 times, 10 days. So you can see why the park can't possibly accommodate all the people who want to go. So what's the solution? They raise the ticket prices. They raise the hotel prices. The hotels are full. Cannot get a hotel. In fact, I just tried. I was going to go now. Come to think of it, we're staying in an Orlando hotel because I went to get a Disney hotel and I couldn't get a Disney hotel because they were all booked up. You could not get 3 consecutive nights in the same room because I left it, it was all last minute thing. So you cannot get 3 consecutive nights in a Disney hotel. I mean, that's crazy at their prices. It's just completely insane to think that that's what they're going for now. And then, of course, obviously, you're there. You're going to be going to the park and so on and so forth. It's ridiculous what they get for these vacations. But anyway, it makes for a good business and a good investment, right? It's a good long-term investment. We already have Disney in our portfolio, so we're not really concerned about it. But like I said, if it comes down, which it may never come back below this 50-day moving average because they've got so much stuff that's going to make money. Although, on the other hand, after a year like last year, when they've gone from obviously 110 to 140, they're up 30%. But they basically were the box office in 2019. Disney was, I think, out of $4 trillion, they certainly were at least, they were over 2 trillion of the 4 trillion. 4 trillion? 4 billion? No, wait. About trillion, billions. That doesn't sound like enough, though. Disney total box office 2019. 12 billion. This one's at, it said 11.9. 10 billion. If you add in Fox, I see, Disney plus Fox is 12 billion, that's why. But anyway, I'm pretty sure that was more than half of the global box office. So that's, I know what it was. It's the US box office is probably is probably total 4 billion, not trillion. US box office is probably about 4 billion. Disney 40% of the 2019 box office. So there you are. So, that's money on the bottom line and so on and so forth. But then you have to say to yourself, well, where do they really make their money? And you can see the Disney breakdown. Parks and Entertainment, 38%. Media Networks, 28%. ABC and such and ESPN. Disney Studios, 18%. So actually, that's a small amount of their total income. It's the parks where they make most of their money. And they just bumped up their parks fees tremendously. So they're gonna be able to drop another, let's say, 4 or 5% to the bottom line. And then this is how you figure out the impact of something. So, if they raise their prices that much, they're probably going to drop 4 or 5% to the bottom line. And then you say, well, okay, in context, well, how much is that then? And then you say Disney, and we look it up. $254 billion. Holy crap. So they're doing $10 billion in sales. 40% is parks, so 4 billion parks. They're going to add about $400 million. They're going to add $400 million to this estimate, most likely. So they're going to punch through this estimate by 10%. Now the question is, though, at $10 billion, they are not such a bargain. This is $254 billion. They come up to $11 billion or so. They start to get realistic, but Disney is not really a great price over here anymore. They were a great price last year when we bought them, when they were down around 110. They're no longer a great price. Why? Because bumping up those park tickets is something they almost have to do, because where else are they going to squeeze the money from? They just have the best box office. That's why this number's down. They just have the best box office ever. There's basically no chance that's going to happen twice. So they had the best box office ever last year. They made that much money. It was already coming down from here, much more money, but their expenses are going up and so on and so forth. They bought Fox. You have to give them a break. But on the whole, it's very hard for them to squeeze more money out of this because of the nature of their business. It's not a high margin thing. It's not like Apple, where if they sell 20 billion more stuff, they're going to make 10 billion more profit. It doesn't work that way for Disney. So, and again, it just goes back to like how stretched out these valuations are. Like even a company like Disney, and even when they're doing the right thing, they're still just fighting to survive. They're fighting to justify these crazy valuations they're being given. Because obviously, if you can't justify the valuations you're being given, you're going to be in for a very harsh sell-off at some point. So what were we doing? Oh, Friday. That's as far as we got on Friday. Ha ha ha. I remember reviewing some plays. I don't know when it was. If it wasn't Friday, it was hopefully Thursday. It's just news. Oh, boy. What are we up to here? 1 p.m. Win. Oh, here's Win. I was liking Win, and they popped in. Oh, look how fast that happened. We put them in the earnings portfolio. Buy 3 of the 120s, sell the 140s, and sell the March 130s. So it wasn't a heavily bullish play, but we used the hedge to sell these calls. And that's in our earnings portfolio. Skechers we were looking at. HBI's Hanes brand, I like them still, and we were talking about a play on Hanes brand. They were cheap, they were better on Friday, obviously, up $1. So it wasn't that day. I don't know. You're gonna have to look in the member chat because I know we talked about a lot of plays last week, but anyway, the bottom line is next week we're gonna start wrangling up these plays, putting together a new buy list, and we're going to start actually adding things to the portfolio because our long-term portfolio is very small right now. Oh, here it is. It's up 6%, which isn't bad, but there's only 10 spreads and hardly any puts. So we have room for a ton more puts. Puts are things that we would like to buy if they get cheap. We have one dividend play in there, which isn't doing well at all, Plains All American Pipeline. And so overall, we're up, well, 6% is actually $30,000, so that's not terrible. We only started this portfolio, well, that's confusing because this was originally the short-term portfolio. It is now the long-term portfolio. And we moved the short-term trades to the new short-term portfolio. But the bottom line is 5% here, so it's $500,000 now, is $30,000. So it's not doing so terribly. And what are our trades here? We have Freeport, which is a copper company, so we like them obviously. GM, we thought was going to do well. They're doing good. They still haven't moved very much. IMAX, just talked about that. Still very cheap. Limited brands, also still kind of cheap, but moving up. The marijuana ETF, we're playing that in various ways, and that's so far underperforming. Philip Morris, as we saw, just sold off drastically. TD Bank, like them. Toll Brothers, like them. And Vail, we talked about that from the top trade, that's over there. And Viacom, also still, a lot of these are not moving. So we're not really doing that well so far, although I guess you'd say, you know, up 6% is fine, but it's a very small percentage. We've used only a tiny bit of our buying power, 173,000 out of a good million in buying power. And we're certainly ready to buy more stuff. So that's going to be our goal for next week, is to come back and try to identify things that we're going to be jumping on top of. And again, assuming that everything is good over the weekend and assuming that the earnings reports out of China aren't starting to look kind of dangerous, which is very possible. But those are my big concerns. Abel says, how about a Matt covered call for 20% return on the dividend play? It isn't craziness, it has been. All right, well, I mean, not really. We can talk about that in chat because I don't really want to get into a whole thing. But because it's not one we generally follow, so I'd have to do a lot of up, and we're about done with the webinar right now. You know, but they are sold off, and then I'd want to say, well, why are they sold off? And I'd have to look it up. So remind me in chat, and I'll be happy to do it. Because they are a good dividend player. Let's see what it actually says here. You're paying $3.4 billion for these guys. And they're making, they're not making that much. They're not growing, they're shrinking. I'm not sure if that's really going to be a good play in the end. So, you know, you like them because they pay a dividend, but that can't be the be all and end all of why I'd want to get into something. Where the heck's my Yahoos? No, it is a fat dividend, I'll tell you that much. So anyway, that would be, it's definitely a lot of research before I'd want to get into something like that. And I don't love where they're at, because with $3 billion, if they're only making, not even making $100 million a year, they're priced, well, there you go, PE ratio 34. I mean, they got a pretty high ratio. You know, I mean, I like SKT, which is paying out 10%, but it's only running at 14 times earnings. The big difference. You know, I prefer, to me, that's a better value, but you know, I'll take a look and see what the merits are for Mac. Then Daniel says, and this will be it because we got to go. Which of your portfolios should I use for 50,000 account? I was thinking to follow the money talk and just divide the positions by half. I've got a few of those positions already. Well, that would be a good way to start then. Money talk is a very low touch portfolio though, so you're going to have to be patient. But you should be patient. I mean, with $50,000, look, with $50,000, the best thing you can do with your money is go get a job. Okay, people who think they're going to take $50,000 and trade it into $1 million tend to end up wasting a lot of their time. Okay, because the way you grow $50,000 by 20% is to go earn $10,000. Don't sit around trading. And the point of the money talk portfolio, or the butterfly portfolio for that matter, is that you don't have to watch it. That these are long-term positions. Let's see if we can show the money talk portfolio. You know, these are nice long-term positions that should make some good steady money. We just added some. These aren't updated. We have a couple of new positions in money talk. One of them is IMAX, I think. So these are good, steady, long-term quarterly positions that we don't touch from quarter to quarter, and they're just things that are absolute bargains in the market. Obviously, last year's trade of the year, this year's trade of the year, and SunPower were the ones I felt the most strongly about back in November when we started this portfolio. And then just recently, and again, it's too late, I can't find it right now, but just recently we just added, I believe it was IMAX and God knows what. But we added IMAX and something else just last week when I was on the show. Oh, well, I guess I could probably find that. Oh, you know what? The best way to find it is to do my own thing. Because I must have written about it on Wednesday, right? If I was on a show Wednesday, I should have written about it Wednesday. And we did talk about that at the last webinar, right? What we were going to discuss on the show. So it has to be here. Here you go. See? Oh, Freeport. Okay, good. That was a good call. So we jumped into Freeport and we jumped into IMAX. So those were our two calls from last week. And so, yeah, you're right. Do half and keep it small. And both of these guys are on a good track. We were at 8.7% last week. Now we're at 11 point whatever percent. So we're up about 3% for the week. And that's not including the two new positions. And obviously it's not going to go up 3% every week, but I mean, we're on a good track and things are working out right. It's good, solid positions in serious value companies. The last money talk portfolio gained 50% a year. This money talk portfolio is on track to make 50% a year. And what else do you want? You know, when you got, you know, don't swing for the fences when you have $50,000. Let it grow. If you can grow $50,000, even 20% a year, that's great. But oh, here you go. I'll leave it off of this because it's one of my favorite things anyway. We do the compound rate calculator. Okay. So, you know, if you have $50,000 and you can go 20 years and you can make 20% a year, right? And don't forget, we're doing way better than that, but let's just say it's 20% a year. You'll end up with $1.9 million in 20 years, right? And you say, well, okay, what if I make 30% a year? What if I'm such a brilliant trader, I make 30%? You're gonna end up with $9 million. It's a huge difference if you do better than 20%. But you know, using it realistic like 20%. But here's another trick that people ignore. If you just add $10,000 more a year to it at the same 20%, that's going to get you to $4.1 million. So instead of sitting there and relying on trading and thinking you're so brilliant, you're going to get it to 30%. If you just go out and get a freaking job and work and make $10,000 more a year that you put into, you know, get an extra job or do whatever, and put $10,000 into the account in addition to the money you start with every year. In other words, every year for 20 years, you put $10,000 more in, you get $4.15 million. At 30%, remember it was 9 million before? At 30%, $17 million. All right, that's double. In both cases, it's double. So instead of sitting around trying to trade your way to wealth, if you just sensibly go out and make more money, get a second job, do something, work harder at work, whatever it takes to make another $1,000 a month. All it is, $1,000 a month that you can put in the bank. You know, you can make that driving Uber, you can make that being a waiter at a restaurant, you can make that with a side hustle of 100 different side hustles. You can have a small business or something, whatever it is. Instead of having a hobby of whatever your hobby is, it doesn't matter what it is, if it takes 20 hours a week of your time, you should be able to make money instead. If it takes 20 hours a week of your time and you're spending 60 hours a week, 80 hours a month doing something, all you have to do is make $15 an hour instead of your hobby, and you will make this money. So try to find a hobby that makes money. Go to flea markets on the weekend and sell t-shirts, whatever. But the point is, if you can just grow at 20% with fairly sensible investments, $4.2 million in 20 years. Because you put 10,000 in instead of 1.9. You double it by putting, whatever your returns are, you're going to double them by putting in $10,000 a year. There is nothing more important. There's no trading secret. There's nothing you're going to do that's going to give you a better return than that. Keep putting money into the bank account, into your trading account, and let it grow. And your dollar cost averaging along the way, you're buying on the dips, whatever, it's all automatically in there, because every month you've got another 1,000 to put into something good, or to add to a position that might be down at the time. You know, yeah, it's great if you can make more than that, but you can't count on that. I can't count on making 30% a year instead of 20. But what I can count on, I can freaking count on my $1,000, right? I can hustle up money. I can figure out how to make $1,000 a month. That's only $12,000 a year. People with zero skills make $1,000 a year, make $1,000 a month. So yes, you can make that somehow, some way. And you know, let's say you're only making 12% a year. That's only $482,000. But if you put in $10,000 a month, it's 1.2 million. It's 3 times. So in other words, the worse your performance is in the stock market, the more impact putting this money away is going to have on you. So that's my advice. It's not about the portfolio. It's about putting it into something that you don't think about, so that you can spend the time thinking about how you're going to make more money. Because that's much more valuable to you at this stage of your life, that you're at a small investing stage of your life. It's much more valuable for you to figure out how to make more money, become a more valuable person, so that you can then start putting it away. That's going to have a way, way bigger impact on your long-term portfolio. All right, that's a great place to finish off, because that's a really good, important point. So I'm glad I made it. All right, guys, thank you very much for coming. I appreciate it, and I'll see you all again next week. All right, thanks very much. Bye.